Hey, it's Thomas here, bringing you a video on the FOMC. Just going to kind of go over a few details, understanding what the FOMC meetings are, how to process them, how do they bring volatility to the markets, and potentially how to trade off of it. So I'm just going to jump right in here. This is actually on the federalreserve.gov website. They have a whole board of governors for the Federal Reserve System website that you can come on to, scroll around, find a lot of good, useful information. Now, unless you're like an economics nerd like myself, you're not going to come in here and read the PDFs and on the minutes and the statements that they've put out in the past couple of months. But you might want to kind of come through here and just read bits and pieces and details of information that might be of use. So one of the favorite things that I like to look is just about the Fed. There's a lot of people out there that don't necessarily know a ton about the Fed. And when I refer to the Fed, it's the Federal Reserve, and the FOMC is just the Federal Open Market Committee. So there's a select group on that committee that make decisions on the interest rates in the United States. So I would definitely recommend you come to this website, just kind of scour through it, see what you like. Where I was just at was going to be under monetary policy. You can find the FOMC meeting down here in the FOMC calendar to kind of find out when these meetings are. Now, normally they're about the third weekish in the month, third or fourth week in the month. Usually on a Wednesday is when they'll release their materials, but the meetings actually start on a Tuesday. So I'm recording this on Tuesday, September 21st. They're actually having their meeting today and tomorrow, but they'll release the minutes and the statement of those of the meeting essentially tomorrow at 1 p.m. Central Time or 2 p.m. Eastern. Now, a few of the things that the FOMC basically will discuss in their meetings are: should we taper asset purchases? Should we raise or lower interest rates? What is inflation doing? They take all these macroeconomic variables and throw them into a pot and put them into an equation and say, how do we best lower the unemployment rate and how do we best keep inflation under control? Those are the two basically targets they're basically the two goals that the FOMC or the Fed has, is to keep inflation around 2% and to have employment at a low rate. Now, they haven't really specified the low rate. Usually it's around about 3%. Right now, unemployment is probably still sitting around the 5 to 6% rate, with the labor market still being very, very tight and constrained. And what I mean by that is you look around, restaurants can't hire anybody. Really, there's a lot of jobs that are open and a lot of people looking for jobs, but there's a problem. There's a disconnect. There's a lack of skills for somebody in a restaurant trying to make, an extra $15 an hour at a different job, but they're not technically skilled for that position. So there's a lot of that going on right now, a lot of digesting from the COVID pandemic, of basically transitioning from what would normally take 10 years into a 6 to 8 month period of COVID. And now we're getting to about the 18-month mark where people are starting to find the jobs that they want. So that's one of the details that the FOMC will deal with. But in regards to the trading aspect of it, the FOMC is actually mostly, you're going to be worried about the inflation rate, because some of the times FOMC will come out, hey, we're going to let inflation run higher than normal. Well, what that means is they're allowing prices to stay above normal ranges that they've had for over, 50 years. So recently we've seen they're going to let it run above 2%. Now, inflation's at 5%. We really don't know how long they're going to let it run above. And I'm air quoting that because they have a few tools at their disposal that they can make happen, essentially. So I'm going to open up one of these statements. So we're just looking at something. Now, as you see, it's just a long PDF that you can read. I say a long 4 pages if you want to read. Now, it's not just a quick summary, but you can come in here and read, say, okay, the Federal Reserve is committed to using its full range of tools to support the U.S. economy, yada, yada, yada. They'll start talking about the inflation rate of 2% over the longer run. Now, obviously, the inflation rate, like we just said, is above that, so they have a few tools they can do. Now, one of the tools that they can use to support the economy is what we know as asset purchase programs, aka they're buying a bunch of bonds, and they're buying corporate bonds, they're buying U.S. treasuries, they're buying notes to suppress lower interest rates. When you buy a bond, the yield on that bond, if you're willing to take a lower yield, then essentially what happens is the yield will continue to decline and decline and decline. Imagine you sell a stock and you continue to sell it and sell it and sell it. Somebody's willing to take less and less and less profit on that trade if they're willing to sell it. Well, it's just the reverse for bonds, to where you're basically bidding up the bond, which pushes the yield down. So all they're doing is keeping interest rates low when they do these programs. Now, when they start to talk about tapering, and I'm not sure if they've actually mentioned tapering in this, I doubt they have. That's the big talk. They have asset purchase programs where they're going to start tapering. Now, tapering is just a fancy word for cutting back, pulling back, scaling back. they're buying 150 billion-ish. My math might be wrong there, but they're buying hundreds of billions of dollars a month in these bonds. Now the market's reacting to them to eventually start slowing down those purchases to allow interest rates to rise. Well, we know once interest rates start to rise, investors will see that they can get a higher rate of return in bonds, take their money out of equity markets and put it into bond markets. So this is the normal rate of action you normally see in the sector rotation we see in general between utilities and tech and back and forth from safer sectors to riskier sectors. Well, this is a sector rotation in a sense of an asset rotation, taking money out of equities, putting them in bonds because it's a safer investment. Because if a bond's yielding 5%, why do I need to hold a 5% risky stock in a sense if something pays, say, a 5% dividend? What's the benefit of holding a stock? If a bond's going to move maybe 1% one way or the other and I'm still getting paid, why would I want to hold a stock that can move 20 to 30% up and down? So that's part of this process in the sense of how the tapering and the asset purchase programs can be affected like that. So let's look at a few of these dates, right? So we have January 28th, 29th, that's 2020, excuse me. So January 26th, 27th, we can see they didn't have one in August. So September 21st and 22nd. So let's go back and see what the 27th and 28th actually looked like for the Fed, essentially back in their releasing of the minutes. So if I go back to, let's find out what it is, say July 27th and 28th. That shouldn't be too far back this way. I'm going to pull up the 15-minute chart here to let us see on a timeline. So July 27th is right about here. So as you can see, we had the Fed meeting here, released at around 1 o'clock. As you see, basically it was bullish for the market. Now, granted, in this meeting here on July, they didn't talk about asset tapering. It wasn't a big enough topic at the time. Now we're noticing that we're gaining strength in the economy, and they're going to start talking about that more in a sense of, hey, we're going to start scaling back these purchase programs because that's the first thing to do before raising interest rates. Now, if the Fed raises interest rates, that's a completely different ballgame. The Fed actually raised interest rates back in 2019 before the COVID pandemic. And obviously they lowered them here, which you saw, which caused this massive market run up. But they also raised them right back in 2018 and 2019. You can see where the fluctuations in the markets weren't as dramatic of an increase. So from the 2018 tech meltdown, about a 45% run up. But if you come over here to the bottom of COVID, this has been a very unprecedented run up of hundreds of percents. Let's see, 105% as of the top of this. Now, granted, we're down some today. But frankly, if you're taking anything from this, think about this. If they raise interest rates, they're going to have to do tapering first. They're going to have to taper their asset purchase programs. So if they come out tomorrow and say, aka tomorrow, the 22nd for this meeting, and say, hey, we're gonna taper our asset purchase programs, in the minds of investors, they're thinking, oh my gosh, okay, they're on the way to raising interest rates, which means it's bad for equities. And really, one of the things I think that this has held this market up is honestly low interest rates. With interest rates at astronomical historical lows, there's really no reason to not invest because cash is trash. Inflation of 5%, what's the only thing that can really keep up with that is real estate or stocks. So that's just a few of the things about the FOMC. There's going to be a lot of volatility right around the 15-minute mark before and after, obviously. So here on the 22nd, around 1 or 2 p.m. Eastern or 1 o'clock my time Central, you're going to see a lot of volatility. Usually you'll see IV pump or implied volatility on options pump right before as well as drop right after because it's now priced in whatever's going to happen. So I'm going to urge you not to trade. I usually don't try and tell people to trade on FOMC meeting statement days, but a lot of people like to play with the action. Just play carefully. Make sure your trade's there. You're going to get stopped out. Usually the market will move 1% up or down in a matter of 15 minutes. So just be careful there. But in general, FOMC, I would definitely come recommend you to this website and just kind of look around. They have a lot of economic research you can look at too. So I hope you guys have a great day, and I'll see you later.